Good day, I am Divine El Cairan, the first reporter. So my topic for today is all about issues in financial intermediation. So changes now occurring in financial markets and their most important institution, banks, present challenges to sovereignty. Domestic challenges includes consolidation, conglomeration, automation, reduction of government banking, disintermediation, and the development of risk transfer markets and mechanisms. There are three issues or problems of financial intermediation. So first, there is no guarantee they will spread the risk. Due to poor management, they may risk depositors' money on ill-judged investment schemes. Number 2, poor information. A financial intermediary may become complacent about spreading the risk and invest in schemes which lose their depositors' money. Number 3, they rely on liquidity and confidence. To be profitable, they may only keep reserves of 1% of their total deposits. If people lose confidence in the banking system, there may be a run on the bank as depositors ask for their money back. But the bank won't have sufficient liquidity because they can't recall all their long-term loans. And that's all for the issues in financial intermediation.
For continuation in this report, I am Kimlin Joyce B. Barrete and my topic is how to measure banks' financial performance. Several ratios are used to measure the profitability of banks and other related industries. Most researchers usually use four measures which include the rate of return on firms' assets or ROA, the rate of return on firms' equity ROE, operating profit margin, and net firms' income. In measuring banks' financial performance, the ROA reflects the ability of a bank's management to generate profits from the bank's assets, though it may be biased due to off-balance sheet activities. And the ROE is only part of the story, as a good level of ROE may either reflect a good level of profitability or more limited equity capital. However, ROA and ROE are more fundamentally used as measures of companies' profitability, since they measure relative profitability and hence more reliable as opposed to the others, which measure the absolute profitability of the company. And that's all to measuring banks' financial performance.
And my topic for today is all about types and functions of financial intermediaries. So what is financial intermediaries? So it is an institution or individual that serves as a middleman among diverse parties in order to facilitate financial transactions. It offers a service or help an individual or firm to save or borrow money. And also, it helps to facilitate the different needs of lenders and borrowers. There are 5 types of financial intermediaries. Those are banks, credit unions, pension funds, insurance companies, and stock exchange. So first is bank. Bank, it is a financial institution licensed to receive deposits and make loans. Banks may also provide financial services such as wealth management, currency exchange, and safe deposit boxes. There are 2 types of functions of banks, the primary functions and the secondary functions. The primary functions of banks, all banks must perform 2 major primary functions. First is accepting of deposits, and second is granting of loans and advances. Accepting of deposits. A very basic yet important functions of all the commercial banks is mobilizing public funds, providing safe custody of savings and entries on the savings to depositors. Banks accept different types of deposits from the public such as saving deposits, fixed deposits, current deposits, and recurring deposits. The second one is granting of loans and advances. The deposits accepted from the public are utilized by the banks to advance loans to the businesses and individuals to meet their uncertainties. bank charges a higher rate of interest on loans and advances than what it pays on deposits. The difference between the lending interest rate and the interest rate for deposit is bank profit. There are 4 types of loans and advances that banks offers. So first are bank overdraft, cash credits, loans and discounting the bill of exchange. So next is the credit union. So a credit union is a type of financial cooperative that provides traditional banking services. Credit unions are financial institutions like banks, except the members own the credit union. There are non-profit entities that aim to serve their members rather than seeking to earn a profit. Credit unions often offer better savings rates, lower loans rates, and reduced fees because of this. Credit unions can be formed by large corporations, organizations, and other entities for their employees and members. Credit unions are created, owned, and operated by their participants. They are buying shares in the cooperative in order to be able to provide loans, demand deposit accounts, and other financial products and services to each other. The third types of financial intermediaries is pension funds. Pension funds are investment pools that pay for workers' retirements. Funds are paid for the either employees, employer, or both. Pension funds are collective investment undertakings that manage employee savings and retirement. Their primary objective is to provide pensioners who have reached retirement age with income in the form of lifetime pension or capital. The example of pension funds are GSIS or SSS. The 4 types is insurance companies. It is a financial institution which underwrites the risk of loss of or damage to personal and business assets and life and limb. Insurance provides protection, provides capital, and improves efficiency. For example, if one purchases health insurance, the insurance company will pay for the client's medical bills. In life insurance, the company will give the client's beneficiary a certain amount of money when the client dies. The insurance company covers its expenses and makes a profit by spreading the risk of any one client over the pool of premiums from many clients. The last types of financial intermediaries is stock exchange. Stock exchange, it is a marketplace where securities such as bonds and stocks are bought and sold. A stock exchange is standardized investments allowing people to buy or sell discrete and equal shares of ownership in various companies. It facilitates the transfer of funds between investors and businesses, regulating as necessary to provide maximum safety for everyone's investments. Stock exchange provides a ready and continuous market for buying and selling securities. It also provides a platform where shares can be sold and bought by buyers and sellers. And that's all for my report.
For the continuation of this report, my topic is the risk in banking. Bank has many risks that must be managed carefully, especially since a bank uses a large amount of leverage. When bank lack of risk management, it can lower profits due losses on loan, and also it leads to bankruptcy. There are 3 biggest risks in banking. First, credit risk. Second, operational risk. And last, market risk. Credit risk is the biggest risk for bank. It occurs when borrowers or counterparties fail to meet contractual obligation. For example, when borrowers fail to meet their obligation contract. And another example, when borrowers default on interest payment of a loan. And the next largest risk in banking is operational risk. Operational risk is the risk of loss due to errors, interruptions, or damage caused by the people, system, or processes. For example, when the teller of machine accidentally gave an $50 to the customer so that the bank can lose some assets. For the last, market risk. Market risk mostly occurs from banks' activities in the capital markets. It is due to the unpredictability of equity markets, commodity prices, interest rates, and credit spreads. In other terms, market risk is the losses of financial investment caused by adverse price of movement. Example of market risk are changes in equity price or commodity price, interest moves or foreign exchange fluctuation. Again, the largest risk in banking is credit risk, operational risk, and market risk. That's all.
For the continuation in this report, I am Alelea Bintilanon and my topic is all about interest rate risk. Interest rate risk is the risk of value depreciation of bonds and other fixed income investments, primarily due to depreciation in their interest rates. This happens because of market fluctuation. Such risk affects many types of investments, though it primarily affects fixed income investment like bonds and certificates. Typically, with the rise in the interest rate of a bond or certificate, there is a fall in the price of all related securities. Additionally, opportunity cost increases too, along with the rise in their interest rate. Defined as the cost of missing out on better investment options, this opportunity cost is directly proportional to the interest rate risk. There are quite a few types of interest rate risk, which must be noted by every investor, be it an individual or a firm. First is price risk. This is the risk of change in the price of an investment, bond, or certificate. This leads to unforeseen loss or gains while selling security in the future. Second risk is the reinvestment risk. This is the risk of change in the interest rate might lead to the selling of the securities. In turn, this can lead to a loss of opportunity to reinvest in the current interest rate. These types of interest rate risk can be further divided into two categories. First is duration risk. This is a risk due to the probability of unwillingness to extend an investment beyond its maturity period. Second category is basis risk. This is a risk of being subjected to a negative downturn in the market. And that's all about interest rate risk.
And the next topic is value at risk or VAR. VAR is a statistic that measures and quantifies the level of financial risk within a firm, portfolio, or position over a specific time frame. Understanding value at risk or VAR. Modeling determines the potential for loss in the entity being assessed and the probability of occurrence for the defined loss. One measures VAR by assessing the amount of potential loss, the probability of occurrence for the amount of loss, and the time frame. For example, a financial firm may determine an asset has a 3% 1-month VAR of 2%, representing a 3 chance of the asset declining in value by 2% during the 1-month time frame. The conversion of the 3% chance of occurrence to a daily ratio places the odds of a 2% loss at 1 day per month. And that's all for the understanding value at risk.
And the next topic is all about credit risk. Credit risk is the risk of loss that may occur from the failure of any party to abide by the terms and conditions of any financial contract, principally the failure to make required payments on loans due to an entity. In other words, credit risk arises when a corporate or individual borrower fails to meet their debt obligations. It is the probability that the lender will not to receive the principal and interest payments of a debt required to service the debt extended to a borrower. There are 3 types of credit risk. First is credit default risk. It occurs when the borrower is unable to pay the loan obligation in full or when the borrower is already 90 days past the due date of the loan repayment. The credit default risk may affect all credit-sensitive financial transactions such as loans, bonds, securities, and derivatives. The second type of credit risk is concentration risk. It is the risk that arises from exposure to a single counterparty or sector, and it offers the potential to produce large amounts of losses that may threaten the lender's core operations. For example, a corporate borrower who relies on one major buyer for its main products has a high level of concentration risk and has the potential to incur a large amount of losses if the main buyer stops buying their products. And the last type of credit risk is country risk. It is the risk that occurs when a country freezes foreign currency payments obligations, resulting in a default on its obligations. The risk is associated with the country's political instability and macroeconomic performance, which may adversely affect the value of its assets. The risk is associated with the country's political instability and macroeconomic performance, which may adversely affect the value of its assets or operating profits. The changes in the business environment will affect all companies operating within a particular country. And that is all about credit risk.
For the last topic is the securitization system and financial crisis. Securitization of mortgage debt is bond-like investments such as mortgage-backed securities and collateralized debt obligation was a big cause of financial crisis. Securitization of home mortgage fueled excessive risk-taking throughout the financial sector, from mortgage originators to Wall Street banks. What is securitization? Securitization is a procedure where an issuer designs a marketable financial instrument by merging or pooling various financial assets into one group. Securitization offers opportunities for investors and frees up capital for originators, both of which promote liquidity in the marketplace. However, securitization most often occurs with loans and other assets that generate receivables such as different types of consumer or commercial credit. It can involve the pooling or contractual debts such as auto loans and credit card debts obligation. That's all for today's topic. First, issues and financial intermediation, how to measure banks' financial performance, types and function of financial intermediaries, the risk in banking, interest rate risk, the value at risk model, credit risk, and last, the securitization system and financial crisis.
Thank you! Hope you learned something!
Bye!